Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thanks, operator. Hi, everyone. I hope everyone had a great, relaxing long weekend. Welcome to the Barometer Readings monthly conference call. This is our ongoing forum to share our insights and observations with the advisors we work with. So building on the last few calls, we've been spending considerable time communicating what the new market framework looks like today for investors seeking income and total return, and we'll elaborate more on this today. On the call, as always, is Dave Burrows, our President and Chief Investment Strategist. So Dave will provide a refresh on our breadth models, discuss the current market framework, and also revisit some of the mechanics we use with stop losses and some recent examples aimed at providing the downside protection. Also, Sal Malik, one of our key portfolio managers, is here to provide more insight on specific themes and names we like in the industrial space right now and what we perceive the catalyst to be. So with that, I'll turn it over to Dave to start.
Great. Hey, folks, thanks very much for tuning in today. What I thought I'd do is take a quick rundown as to what we're seeing in our top-down work, where we see opportunity, what changes we have been undertaking in the portfolios, and sort of give a view as to how we go forward here. So consistent with our most recent number of calls, when we look at it from top-down, the equity asset class continues to see new dollars get put to work. That being said, we certainly have seen markets work their way sideways here over the last number of weeks. And I guess in the last couple of calls, we've highlighted the fact that, after a very good year last year, I think there's been a lot of expectation of some significant type of pullback. We don't see that in our breadth readings. In fact, on the other hand, what we are seeing is that the market is working its way sideways, correcting over time as opposed to price. So we've seen some internal rotation. We've seen less flows into equities over the most recent number of weeks, although in the last couple, flows have started coming back into equity markets. So breadth globally continues to be around 52%, so 52% of stocks in long-term positive price trends. The majority of developed markets, consumer-led economies, are seeing the most broad-based markets. If you take a look at EM continues to have more narrow leadership. And despite short-term rally over the last few weeks in some EM markets, we are starting to see some strain, and that leadership is starting to fail. So when we look at equities, we continue to be impressed by the fact that the equity risk premium continues to be very good. Our job is to invest where we get paid to take risk. And earnings yield for the S&P continues to way exceed yield in a 10-year bond. We're getting close to 400 basis points of excess return. So it makes sense that money would be slowly rotating towards equities. Different than last year, we are not, of course, seeing strain from rising interest rate. In fact, it's gone the other way. Falling inflation and some expectations around QE in Europe have bond markets improving. That also should be supportive to equity valuation. And when we look at spreads for investment grade and high yield bonds, they continue to be very narrow, which to us say we don't get paid very well to take risk in those two camps. So we have not been adding anything in the corporate bond space. From a sector perspective, over the last 2.5 months, really the most significant improvement has been in the energy space. And as I think many of you know, we've had significant exposure to energy infrastructure over the last 3 years. That continues to behave extremely well across both our equity and income mandates. It continues to be a very substantial theme, and the numbers continue to get better. So we continue to expect additional dividend growth, additional opportunity to invest with good economic returns on long-life projects, and no change in that theme. In the last call, we talked about the fact that we have taken up our energy exposure to producers E&P companies, specifically growth oil companies in the U.S. who are using new technology to find new reserves and add new production at falling costs. We've added exposure in the heavy oil companies in Western Canada as we expect the differential between Canadian Western heavy oil and a WTI to continue to narrow. We have increased our weight to natural gas producers given the fact that storage continues to be at very low levels. And we have been focused on yield-driven oil and gas producers. So our largest weight across our portfolios continues to be energy. Having said that, it's broken into about 5 different themes. As I mentioned, geographically, we continue to focus on developed markets versus emerging markets. An interesting development over the last couple of months, as you've seen some profit-taking in small and mid-cap, more domestically focused companies, the higher beta names, you have seen that beta money work its way to EM. And based on breadth models, it does not appear that that is a theme that is something that will be sustained. On the economic front, if you look at GDP growth in the developed markets and specifically the U.S., very good versus what's happening in EM, which we're seeing deteriorating GDP growth. So it would speak more to counter-trend rally than something that's sustainable. When we look at the portfolios, energy continues to be our most significant theme, led by energy infrastructure, but then E&P companies. An extension of that would be the industrials theme, industrial companies in North America benefiting from a more predictable supply of inexpensive energy. Sal's going to talk a little bit about some of the themes in the industrial space. After correcting through February, March, technology, especially oil technology, continuing to behave quite well. A lot of those more dividend growth-oriented names. Healthcare continues to act well. Even the biotech space, which I think 2 calls ago we highlighted, had pulled back significantly in our breadth models to turn positive, are becoming more productive. And the leading names like Gilead acting very well. Probably the most important theme that we're focused on across, especially the income portfolio, it continues to be dividend growth. And the dividend growth theme is alive and well. Stocks are behaving extremely well across many sectors. Dividend payout in the S&P continues to be below 34% against the long-run average of 50%. And we are seeing good dividend growth. When you look at the fact that we've seen remarkable dividend growth, we've seen significant share buybacks, and are now seeing a ramp-up in M&A activity, it is interesting. You put all that together, and the S&P still is hitting new highs of cash levels on balance sheets. So there continues to be lots of cash to be deployed. Of note, mergers and acquisitions really have picked up. We're coming in Monday mornings almost every week to see big deals taking place. That should be supportive of markets, telling you that strategic buyers see valuation at current market price as being attractive and an opportunity to be accretive in their earnings. So we continue to expect to see mergers and acquisitions. And correlations continue to fall, which speaks towards targeting specific themes. So from a sector perspective in the income portfolio, energy is our largest weight at 37%. We talked about that in the last call. Financials would be the second largest weight at 28%. Our third biggest weight would be telecom. That's a long-running position. Companies like TELUS, industrials, 8%, technology, 6%, consumer discretionary, 3%. As you can imagine, given the fact that we have very little weight in Canada in technology and consumer, we do have a reasonably substantial 25% weight in the U.S. to take advantage of that. In the equity portfolios, energy, again, largest weight, mid-40% range, 46%. Industrials would be our second largest theme, a little bit less dividend-focused. Technology would be 14%, consumer discretionary would be 10%. If it is that the emerging markets counter-trend rally starts to fade here, it would not be unlikely that the mid-cap, more domestically focused companies would retake leadership in this market. Many of the companies that we follow have pulled back within trend, but are now turning back higher. And that is interesting because EM and commodities, and some of the commodity currencies, look as though they are running out of gas and reversing down. So the negative correlation between the two should mean you should see a bid coming back to the smaller cap and mid-cap domestically focused names. Now, in the last week, obviously a little volatility in a few names. One name in particular, which has been a large holding for us, CI Financial. Sarah was mentioning we've had a few calls coming in asking how the behavior in CI relates to our stop process. And I thought it might be just useful to revisit the purpose of the stops and how we execute and when we get shaken out of positions. So the reality is the stops are there to make sure that we don't let opinion get in the way of making a good decision. We always are looking for companies that meet some very specific financial characteristics, but we want to see the price characteristics support the view. We know that stocks pull back all the time, even leading stocks. Especially if you get into a secular bull market, you will often see that corrections come in the leading names, and it's profit-taking. So there is no manager who will ever be able to defend against short-term pullbacks in stocks. These are a reality of investing in the stock market, and we don't try. What our stops are there to do is to take us out of positions when behavior starts to change, when trends start to break. So when companies have performed well for a long period of time, they are prone to pullbacks. It does not mean that they break trend. And in fact, the last thing you want us to do is to be a seller when a stock's pulling back within trend. So, we use point figure charts and we use some other tools to help identify those change points. Then something like CI, a pullback that even may seem substantial in percentage terms, is not enough to break long-term trend. So if you have one stock, like say an IPL that has very little volatility, and another stock, like say a Micron Technologies that might have a little bit more, to pick some random percentage point below the price that it's currently trading at, use that as a stop, I don't think makes much sense. The point and figure charts help us to recognize changing long-term price trends. So we'll continue to behave that way. We're going to continue to see pullbacks along the way, but in general, we like the way the portfolios are structured. So what I'd like to do is pass it over to Sal. I'm going to get Sal to elaborate a little bit on our weighting in industrials. Industrials, while have not been immune to pullbacks, have held in extremely well over the last 2 months while markets have been seeing rotation, and we think for good reason. I'll let Sal elaborate a little bit.
Hey, thanks, Dave. So basically there are 4 areas within the industrial space that we are targeting. One is airlines. Second thing is rail cars, third, auto parts, and fourth is the chemical space. So I'm going to start with the chemical space. We have a big position in Lyondell. The company basically uses ethane and propane, which are produced from NGL. And as we know that production of oil and natural gas is increasing in North America, especially in U.S., so there is an oversupply of ethane and propane in the market. That has led to cheap feedstock for Lyondell to make various kind of chemicals. That has resulted in a high EBITDA margin for the company. Currently, the company is the free cash flow yield is 6%, and they are set to buy back 10% of the shares outstanding. But one interesting thing that I would like to share with you guys is that what's happening in U.S. is that because in U.S. you can't export oil, they are actually building condensate splitters in the Eagle Ford play. So what happens is that if you export condensate to Europe, where Lyondell has a lot of refining capacity, to create product from condensate requires minimum amount of cost compared to if you export ethane. So we believe that the European business that accounts for 15% of the EBITDA right now can go to around 20 to 25% over the next 2 years as more and more condensate splitters get built in U.S. to take condensate and export it to Europe. And their CapEx expansion in U.S. is coming along quite well. So So we really like this name because they're buying back stock, increasing dividend, and margins are getting better. Within the airline space, we have a good position in Air Canada and American Airlines. We like American Airlines because the capacity expansion in U.S. Has been slower than GDP growth in U.S. over the past 3 years, so the pricing has been quite firm. That's why the load factors are over 80 to 80.5%, and revenue per mile has been increasing. So the margins are expanding, and because this is a fixed cost business, if the costs are stable, then the company go through multiple expansion, and that's what we have been seeing in the airline space. Same is the case with Air Canada, where their costs are coming down because they're introducing new Boeing planes that are 20% better in transportation, and their RASM is increasing by around 10 to 12%. So, and their load factor is above 80% too. So again, earnings are getting better, margins are getting better, and we're going into Q2, Q3, and they're the only company within Canada that provides you business class. So the business class part of the market has been doing quite well as we're seeing better activity in the economy. Within the auto parts space, we really like Magna. We have been long Magna for almost 2 years now. Currently, 20% of their bottom line comes from Europe, and where their margins, EBIT margins are around 2.6%, whereas they're making 10% EBIT margins in U.S. We believe that the European auto market will keep getting better. Right now, the amount of cars being sold in Europe are around 19.2 million units, and we believe that they're still 20% below the peak level. So as the amount of cars being sold increase, as the economy gets better, we think the EBIT margins can move towards 4.5%. That's the guidance that we have received from the management team. So we believe that would lead to a further multiple expansion and earning revisions to the upside for the company. Magna has zero debt. They have $1.5 billion of cash on the balance sheet, and they're increasing dividend aggressively. We received almost a 20% dividend increase this year. So we really like this name in the industrial space. And the fourth sector I talked about was the rail cars, and within that we really like CNR. Just to give you an example, by the end of this year, almost 20% of oil and NGLs that we produce in Canada are going to move by rail. So it's a new source of revenue for CNR, and we think it will keep growing, and their profitability will keep getting better. Plus, if you go 10 years back, lumber used to be 20% of the bottom line for CNR, and as the housing stats in U.S., we believe, move towards 1.1 to 1.2 million, the amount of lumber getting exported will increase. Again, it's a company that's growing revenues and earnings in double digits. They're buying back stock. They're increasing dividends, and as we expect a stable economy, we think the company can go through further multiple expansion. So with this, I'll pass it back to Dave for closing remarks.
Great. So I guess what you should take away from this call is that the equity breadth models for developed countries continue to be positive. Despite some rotation over the last couple of months, the long-term themes in industrials and technology and healthcare continue to be strong. The pullback in smaller cap and mid-cap, more domestically focused companies looks to be resolving back to the upside. The rally that has been shorter term in nature in emerging markets and commodities looks to be failing. We are staying with our key themes. Dividend growth continues to look very attractive in the face of very low interest rates that are showing no signs of going higher. So risk reward continues to be in equities. We get paid to take the risk. We are seeing excellent dividend growth in the portfolio. Close to 50% of our holdings now in the income portfolio have given us dividend growth of anywhere from 3 to 100%. We 3.5% to 4.5% yields in the portfolio and get 7 to 9% dividend growth against the backdrop of very low interest rates, this portfolio should continue to behave extremely well. Economic surprise data in the U.S. has started to show improvement over the last 2 weeks after underwhelming going through winter due to weather. Clearly, the market is going to look to see improvement in the economic data as we go forward, but we are not invested making a bet on a big economic resurgence. We are invested in companies with very predictable cash flows, very low dividend payments, and higher dividend growth. So with that, I think I could sort of tie it up and bring it to a close. If you've got any questions, certainly we're happy to answer them.
Sure. Maybe just before we accept any questions, I'll just close out with a few summary remarks, and then we'll open it up to Q&A. So obviously, the market is an ever-changing beast at Barometer. It's something we're always watching very closely in terms of areas of expanding breadth where we see opportunity, but also examples of the downside mechanics with the stop losses. So I think Dave did a good job of highlighting the market framework where we continue to observe market breadth, where we're allocated, and what the stop loss mechanics could look like, because we have those discussions, or people ask that all the time. Secondly, Sal gave kind of a 4-part review of the industrial area and what, we're always talking about positive change catalysts and companies that have traits that show they are good and getting better, and I think that those are all perfect examples of that. Dividend growth, I would say that if you're interested in a review of what the dividend growth pictures look like in our income strategy, ask Sarah or myself to send you the latest slides, or Kayla, because we've done a good little synopsis on that topic. Performance-wise, it's interesting, last year we talked about it being a transition year, and we're almost halfway through 2014. We've been very active, and the case for the income mandate continues to be very strong. Performance is for income strategy anywhere between 4 and 5% between the pool and the fund, and our new small equity prospectus-based fund is up close to 3% as well. So not bad for a straight equity product. So with that, at this point, we'll open it up to questions.
At this time, I would like to inform everyone, in order to